All right. Thanks, folks. Sorry for the delay. Again, little connection issue, but we're good now. So today, the title of what we're going to talk about today is trading breakouts. Okay. And so we'll make this part lesson and then try to jump into the market and look for some setups as well. All right. All right. I think I'm officially organized now. Thanks for bearing with me here. Ago in FXStreet, we identified this area right here as a supply level, and we that allowed us to accurately determine that prices were very likely to turn lower once they hit this level here. Okay, we combined that with share one more chart with you here. Okay, take a look at this one. With this chart, okay, the euro, larger time frame chart. At the same time, we identified that U.S. dollar supply level. Okay, we identified the euro at the same time was declining right down into a demand level. Anybody in here actually able to get part of that trade, part or all of that opportunity? Dollar into supply, euro into demand. That was, I think, 2 sessions ago in FXStreet, last time I was here. Well, the point is, the only way we were able to get those, okay, was because of the ability to time the market's turning points. All right. So I want to share quite a few things with you today that will teach you how to do that. That's the whole point. All right. Now, the title of today's session is Trading Breakouts. Nice job there, whoever got that. Good job there. So the title of today's session is Trading Breakouts. Okay. Now, breakouts are probably the most popular entry into a market or strategy there is, right? You have plenty of breakout traders, especially in the Forex market. Forex market is dominated by breakout traders, right? Well, if breakout entries are so popular and have been around for, forever, and it's what most people do, how come most people don't make any money trading breakouts? Okay. In fact, I think you'd have a very tough time. I think you'd have a very tough time finding anybody that makes a consistent living trading breakouts. All right. So the combination of market timing and trading breakouts, that's the topic for today. We're going to combine the two. I'm going to share with you how to do this. Let's jump right in here. So let me bring up all right, here. We're going to start with this chart. Let me grab it for you. Yeah, and this is being recorded, so. Okay. So everybody should be able to see the screen. Got a chart up here. Everybody should be able to see my pointer. Let's take a look at this level right here. Okay, so by the end of today's session, my goal is that you can have a pretty solid understanding of how to time the market's turning points, like we did with the euro and the dollar. Okay, and that's really going to help you. If you're someone who's struggling trying to make breakouts work, I think you're going to understand how to make that happen as we go along here. So take a look. So right here, prices are trading sideways, right? Supply and demand in this area appears to be in balance. Understand that when prices drop as they do here, they drop because actually at the origin of that drop, supply exceeds demand. Okay? It's the first step in identifying market turning points, the first step and most important step in identifying breakouts and such, okay, is to quantify real supply and demand in the Forex market. We can do that by simply looking at the price action. Okay? So when price moves away from this level as it does here, we know that supply exceeds demand in here. Okay? So we let this move away, or keywords breakout, let this breakout happen. Don't try to short on this breakout. Let this breakout happen, because once it does, that gives you all the information you need for to identify this level right here as a supply level. Okay, so we want to wrap 2 lines around this level, which at the origin of the breakout, right? Wrap 2 lines around this level based on a very specific set of rules that we should have time to go over here. and carry that level forward. Okay, creating a supply zone or sell zone. Next, down here, just the opposite is true. Again, prices are trading sideways. Supply and demand appears to be in equilibrium, right? The truth is, it's not, and we know that because prices break out to the upside. Again, we don't want to enter this breakout here. We want to observe this breakout, okay? So let the initial breakout happen, because once it does, that's when we can say, aha, we now know where the real bank or dealer demand is in this market. It's right here. Okay. Now, how can I be so confident when I say that this is a demand level, that demand exceeds supply here, or supply exceeds demand here? Well, because if that statement was not true, there was actual supply demand equilibrium here, prices would still be trading sideways. But the fact is, price had to rally away from that level, okay? Because supply and demand is out of balance. So, a different type of message that I'm giving you here is, don't go for the initial breakout. Let the initial breakout happen, because that gives you all the information you need to quantify the real supply and demand imbalance equation at specific price levels. Okay? Let me back up just a second. Why do we care about a supply and demand imbalance? For the simple reason that, that is where every market turns. That's where all the turning points are in markets. Okay? Prices turn in markets at price levels where supply and demand are most out of balance. If you all agree with that, the only question left is, what exactly does that picture look like on a price chart? Okay? That's what we're going over here. Okay? All right? So, let's take a look. We'll try to go for questions at the end, but let me see if I can get to any here. So Alexone or Al, whatever your name is there. I see your statement, and yes, notice the key words there. The second time price went to a level. Okay, so one of the most important things is, a lot of people will say, well, prices blew right through this support level or this demand level or whatever you want to call it. But I think what you need to focus on first is, what is demand? Because support to you might be very different to me. Remember, there are tons of different definitions of support and resistance. To one person, it might be a moving average. To another person, a Fibonacci retracement level. To someone else, a pivot point. So let's quantify. I think as we go along in here, you'll see how why we focus on certain levels and why we ignore others. And as you say there, the second time it didn't work. Yeah, we don't want to enter positions the second time into an area. We only want to enter positions the first time into a level. Okay? All right? So when prices revisit this level here, okay, so now they're revisiting the origin of a breakout. Okay? That's where we want to be a short seller. When price is revisiting the origin of a breakout to the upside, that's where we want to be a buyer. It's a much higher odds, much lower risk and higher reward trade when you are taking it on the first pullback into these areas, not on the initial breakout. So the difference here is, instead of buying on the initial breakout that I'm pointing to here, might be a good idea to let this breakout happen, because that shows you where all the real willing buyers are, and then buy when prices revisit that level for the first time. Okay. But now, how do we quantify where the best levels are? Okay, we'll get to that in just a minute. Just a quick little look here. So when you drop, base, rally, consider buying the first pullback. That's the low risk, high reward, and high probability way to trade a breakout. And of course, just the opposite is true on the short side. Okay. But now let's take this stuff to a whole new level. All right, let me capture another screen for you here. Now, what we're now is probably the most of you have heard some of this information before. You've been with me in these sessions, okay? So some of these trades are trades right out of the trading room at Online Trading Academy, the XLT program, and actually all these are. Take a look. So I started my career on the floor of the Chicago Mercantile Exchange, so I had orders right in front of me. You could see the different price levels, or you could see the order flow at the different price levels. You could see the level of imbalance at specific price levels. Okay, and but we don't see that here on the price chart. And if you're in the Forex world, it becomes even more of a challenge, right? Seeing real volume and all the banks volume at one time, all the dealers, everybody, right? All the brokers. In the Forex world, it's even tougher, right? Well, the good news is we don't care about that because the price chart shows us everything we need to focus on, okay? If you know what you're looking at. So follow me here, all right? Let's take a look. Yeah, so Francisco, yeah, anything I'm talking about here is equally applicable across any of the time frames, whether you're a short-term day trader to, longer-term swing trader in Forex, okay? All right, so take a look. You should be able to see this next slide here. All right. So now, what we're going to do now with this information, help identify where supply and demand is most out of balance. That does two things for us. Number one, it's going to have market turning points we should look at. Okay, and number two, it's going to force us to ignore all the other levels that we don't want to pay attention to. Okay, I'd say out of every probably 10 supply or demand, resistance or support levels, whatever you want to call them that we find, we're probably only focused on 2 of them. The others, the others we want to ignore. Okay. All right. So take a look. I'm gonna talk about 3 or 4 items here. Number one, we want to identify how prices broke out away from the level. How did prices leave the level? So here's a little supply level for us. Here's the breakout, right? Remember, the topic today is how to properly trade breakouts. So here's the breakout, okay? Now what we want to look at here with item number 1 is how did prices break out away from this level? Was it one of 3 ways? Was it a gradual decline away from the level? Was it a stronger breakout away from the level, maybe with big red candles? Or was it a gap away from the level? Okay? Out of those 3 choices, which one represents the strongest supply and demand imbalance? The gap, right? Exactly. Good job. Okay? So, when you have when the breakout away from the level is a gap, in other words, let's say it like this. The stronger the breakout away from the level, the more out of balance supply and demand is at the level. You don't need to see the bank's orders. You don't need to see the dealer desk. You don't need to see the market maker. It's all right here. The price action will tell you how out of balance supply and demand is at the level. So stronger the breakout, better the area. Number 2, and this goes hand in hand with number 1. How much time did the price spend at the level? So we're talking about this area right here where you see 4 candles. Okay? Now, you don't see 10 candles here. You don't see 20 candles. You see 4, right? Now, what most of the books will tell you is that trading books is, you want to find your key market turning points are always going to be areas where there was lots of trading activity, where there was heavy volume, and so on and so forth. Okay? All right. Good question there. Can I consider final week's gap? You can. Just make sure it's a strong gap, a strong move away from that area, right? Okay? All right. So take a look. So here, so the breakout away from this area is very strong, okay? Which means that when prices revisit this area, here's where I put on the short position right here with a protective buy stop just above the area, okay? Now to the left here, you can't see it here because it's a picture, but there was really nothing down here, okay? So there's a nice big profit margin with this one. But anyway, the whole point is strong breakout away from the area, short the first retracement, okay? Short the first retracement. Okay. Let's add another one now. Hopefully these are helpful. Okay, just to get your mind thinking in a little bit different from your competition. You don't want to be thinking like other traders do. You're buying and selling where other buyers buy, but you have to have an edge. Okay. So let me ask you this. Again, the most important thing here is the logic has to make sense. Another way of saying that is, you can't trust, you have to be careful who you trust in the trading world. For example, the world of trading education, right? How many times have you seen an advertisement for a $5,000 trading strategy that's going to make you, 20% a month, right? And then for an extra $10,000, they're going to tell you the big secret, right? Well, I'll tell you, and I'll be very strong when I say this. Don't trust anybody in this business. Make sure, the people that you should trust are the people who have sound logic. Okay, if something seems too good to be true in the world of trading and trading education, it almost always is. If something seems too complicated, it probably doesn't work. Okay, you always want to. Most people, they'll read a trading book and they'll say, the book will talk about a price pattern, for example. Maybe it's conventional technical analysis. They'll talk about a price pattern, and right next to it, this pattern works. 80% of the time. Well, then people will just go try to identify that pattern. That's the wrong approach, in my opinion. Make sure the logic is sound. Let's use this one as an example. Forget the chart for a minute. Let me ask you a couple questions. Okay. Let's say you're at a bank. Okay, you're a Forex trader for a bank. So you see all the orders. Maybe you're on the floor of an exchange like I was, and you can see all the orders there. Let's say you're watching the euro, okay, and let's say price is at a price level of 128, and you see at 128.40 there's a huge stack of sell orders, large amount of supply, okay, at 128.40, and you see that there's really no demand until about maybe 127.50. Where are you going to feel comfortable selling short in that market? Make sure everybody understands this. And just answer me honestly, where are you going to feel comfortable selling short in that market? Probably 128.40, right? Okay, if that's where all the supply is, you're walking down the trade desk and you see a huge stack of sell orders at 128.40 and no demand till 127.50, you're probably going to feel comfortable selling short at 128.40. Okay? So, if you agree with that, then answer this question. Is there anything that would make you feel more comfortable selling at 128.40? What would make you feel more comfortable selling at 128.40? Assuming that you saw what you saw and all that information was true. Well, how about this? How about if you looked at the trade desk and there was another big stack of sell orders, in fact, a bigger stack of sell orders at 128.41? Which, if there was a bigger stack of sell orders at 128.41, would you feel more comfortable selling at 128.40? Probably, right? Now you've got two big levels to lean against on the short side. Does that make sense? So if the logic makes sense, then the next step is just say to yourself, what exactly does that picture look like on a price chart? It's right here. Okay? Number 3, levels on top of levels. We've gone over 1 and 2. Let's go over number 3. Levels on top of levels. So here we have our supply level. Rally, base, drop. That's what RBD is for. The pattern that represents supply, where the real sellers are. Just below that, we have another supply level. Little rally, base, big drop with a gap. Okay? Supply level on top of supply level here. Big stack of sell orders on top of big stack of sell orders. Makes sense? Okay? So given that information, and now again, price gapped away from this level, suggesting lots of supply here. The question is, okay, all right, who is buying here? Well, who do you want to trade with? You want to trade with people that are novice market speculators. You want to trade with consistent losing traders. I hate to say it that way, but that's the real world. Okay, coming from the floor of an exchange and then trading off the floor for so many years, I find that the consistent losing market speculator, the novice market speculator, always makes two mistakes. They leave pretty obvious footprints. Okay. If we focus on the buyers right here where I'm pointing to, these buyers are making those two mistakes. Mistake number 1, they're buying after a big rally in price. Mistake number 2, they're buying right into a price level where supply exceeds demand. Okay? So instead of being the novice buyer here, we want to be the seller to this buyer. Okay? And again, keeping to the topic, notice the origin of the breakout here was very strong. Prices broke out here to the downside, and then an even stronger move to the downside here. Okay? So when we see that, the entry point is selling short on the first retracement back up into that area. Okay? Let me just back up for a second. All right, just making sure the questions here. So yeah, so when you have levels on top of levels, there's really a couple ways you can enter that position. You can either enter, well, there's I guess 3 ways. You can enter the whole position at the lower level, right? Or you can enter part of the position at the bottom level, a little bit, more of the position at the upper level with a stop from the whole position above both areas. But what you want to do to make that decision, remember, most of what we want to do here is make things as rule-based as possible. So the stronger the move away from this, the stronger the breakout from the lower area, okay, the more we want to put on the bulk of our position at or around the lower area here with a stop above that, because that means prices are probably not going to go too deep into that upper area. Okay. Yeah, you're right, Fuji. Novices always think they're missing the boat, right? Novices buy after a rally in price, and they buy right into a price levels where supply exceeds demand. Now, why do they do that? Why would someone be such an aggressive buyer here, right? Well, think about how people are taught to buy into markets. They're taught to wait for a big uptrend, nice uptrend in price, wait for good news, wait for upsloping indicators and oscillators. Only novice traders wait for those things, right? The consistently profitable traders are already in the market before you have a nice trend and all that other stuff, right? Okay. By selling short right here, it's the lowest risk. Yeah, fundamentals is too as well, Carol. Exactly. By selling short right here to that novice buyer. Now the buyer, remember, they're just doing what they're told. They're doing what all the books say. We have an uptrend in price. Good. We want to sell to that buyer. That's what I did here. Now selling here is the lowest risk, highest reward, and highest probability time to sell into that market. But again, we don't want to be selling short against any old supply or resistance level. Just like we don't want to be buying against any old demand or support level, right? We want to be able to look at the price action, consider a number of things that will help us identify the most significant supply and demand levels, because that's where prices turn. Let's go to another one here. Okay. So here's the next screen. We're going to add one more here. Now, there are more of these, but I want to give you 3 or 4 of them here today. So Ken's asking me a good question. How do you identify a strong breakout? Bar size, number of pips, number of common bars, things like that. Yeah, we'll talk about that here in just a minute, okay? Yeah, Gigi, you want to see the pattern rally-based drop and drop-based rally. What those patterns do? Now, there's you can take it deeper than that, but just on the surface here, by focusing on that pattern of supply and demand, that's going to force you to trade out at the extreme. There are other levels in between there that I know we go over occasionally. We don't have time for it today, but those will force you out at the extremes where the odds are stacked in your favor and stacked against your competition. Okay? Some are, Jake, and we have some XLT members with us here today, and again, we try to go over as much information as we can here. Of course, I'm always faced with the double-edged sword of wanting to give as much information as we can, but also too much information. That would not be fair to the XLT members that put in all the time and everything. But let's not worry about that now. Let's keep plugging away. Plenty to go over here. All right, so let's look at number 4. Now, this is another item that's very important when it comes to quantifying supply and demand with the goal of identifying the key market turning points. How far did price decline before returning back to the supply level? So here's the supply level. Here's the strong move away from this level. This is in the euro. Okay. Now, what we're focused on here, this item number 4, is the distance from the origin of the breakout right here all the way to this lowest low. Okay. In other words, how far did prices move away from the level before returning back to the level for that entry point? Okay. Remember, most of the time we don't want to just sell short on a breakout here. Okay. The reason why people are not successful with that, okay, The reason why people are not successful just shorting on a breakout, there's a couple reasons. Number one, you only know a breakout is a breakout after it happens. Okay? So by definition, your entries are never going to be low risk and high reward. All right? And often, right after the breakout, price comes right back for the entry point. This one took a little time. Took a little time, but most of the time it happens pretty quick. So the breakout traders, unfortunately, almost always get stopped out in that quick retracement. And right as they're getting stopped out, the real unfortunate thing is that's when it hits them, they think, oh boy, this is where I should have been entering in the first place, not on that breakout. All right, so let's get back to item number 4 here, because this is an important one. The logic here is the stronger the move, or the farther price moves away from the area before returning back to the level, that hits on probability. Okay, and profit margin. On the probability side, okay, the issue is when I sold short here to the buyer who was buying after this rally in price and into the supply level, mistakes number 1 and 2, okay? The fact that price moves so far away from this area before returning back to it means that the buyers here aren't just making any old mistake. They're making a huge mistake, okay? A really, really big mistake. In other words, they're not buying, they're not buying after any old rallying price. They're buying after an enormous rallying price, right? That's the big mistake. They're not buying low on the supply-demand curve, right? They're not even buying near equilibrium. They're buying way up on the supply-demand curve where the odds are completely stacked against them and obviously stacked in the side of the sellers. Does that make sense? Okay? Again, make sure the logic makes sense. Don't even take anything I'm telling you, as fact because I'm saying it. Make sure you run everything everybody says to you in the trading world. Make sure you run it through your logic filter. And here's the key. Okay, here's the most important thing I can tell you. If when someone is telling you where to buy and sell in a market or giving you a strategy, if that strategy is not in line with how you buy and sell things in other parts of your life, at the grocery store, when you're buying a car, when you're buying a house, it doesn't work. Okay? The biggest trap out there that people run into in the trading world, in the investing world, is that people think that somehow how you make money buying and selling things in every other part of your life, which we all know how to do, they think that is somehow different from how we should be operating in the markets here. The big thing is there is no difference. You buy low when things are on sale and you sell high when things are overpriced. Another way to say that, buy wholesale, sell retail. That's what every successful Forex trading desk does. They sell at retail prices, just right here in the supply area. That's retail. You don't have to call it supply. You don't have to call it resistance. Call it retail. That's what it is. And they sell at retail prices and they buy at wholesale prices. That's all I'm telling you to do, suggesting you do here. So, on the profit margin side, okay, again, given that price had to travel so far to get to this supply or retail price level, again, that means that you're way high up on the supply-demand curve, and when the profit margin on shorting opportunities high on the supply-demand curve are big, right? That's where you're going to find big profit margins if you're the seller, all right? Okay. Jason, I guess you bring up kind of a point there. But you know what, Jason, the truth is, though, I mean, yeah, when most people buy, certain things, but let's say it's like something at the grocery store, right? Yeah, credit cards, true. That's true, right? But that's kind of more, I think in general, people at the grocery store, like if you have a favorite food, right? Let's say it's strawberries, and maybe the package of strawberries is $2 a package, right? You know, for the most part, if you buy strawberries all the time and you love strawberries, especially when you put like whipped cream and stuff on them, right? If you love those things and they're almost all, and then usually they're $2. If you walk in the store and there's a sign right in the front that says, "Hey, your favorite strawberries are on sale today for $1," right? And we only have a limited supply, and the strawberries are actually in the back corner of the store. What do you think the person that loves strawberries is going to do when they walk in the store, right? Are they going to just, casually walk back there and get some strawberries? No, they're probably going to walk a little faster than they usually do. If they have kids with them, they're probably going to run, say, "Hey, you guys go grab as much as you can and bring it back to my cart," right? Okay? We all do that. We all have that mentality. But for some reason, when people put their hard-earned money at risk in the market, they do the exact opposite. Okay? They don't want to buy when things are on sale. The vast majority of people buy on good news. They buy big breakouts. They jump on this bandwagon mentality trading. And let me tell you, the consistently profitable trader is laughing all the way to the bank. You know, it's not that hard for Wall Street to make money. They buy wholesale and sell retail, right? And the reason why it's not hard for them to do it is because they know that the average person buys retail and sells wholesale. Okay? All right. So anyway, I think you get the point here. All right? Again, selling short right here with a protected buy stop just above the area, and then benefiting from a downside move. Remember, not selling short on the breakout, but selling short on the retracement back to the breakout. By waiting for prices to come back to the origin of that breakout, you have so much more information. It's so important that you do that. Okay, these 4 items, and there are some more. Let me give you one more actually, because it's an important one, and it's something that someone was asking about in the beginning. That's why I remembered it. But it's the number of retracements. So you see how this is the first retracement into this level? Remember, in here, and again, I started on the floor of exchange, and actually started in the currency. Right here, there's a big stack of sellers, right? Big stack of sell orders on the trade desk. There's X amount of supply here. So when prices come back right here, some of that supply gets absorbed, right? Every time price comes back here, and we have buyers, some of the sellers get to sell. So one of these items that you want to focus on is we want to be a buyer or a seller on the first retracement into an area that has a big profit margin. Okay. So in other words, when all 3 of these items or 4 of these items are true, if you were to add a 5th, you would say, I want to get in on the first retracement to the origin of the breakout. Okay. Because remember, with each successive move back into an area, a supply or demand level, some of that supply or demand level is becoming weaker and weaker and weaker because those orders are being absorbed. Okay, so if you see a level and prices kind of blow through it, chances are it's like the 3rd or 4th time. You would never want to take that anyway. Focus on the first retracement. Okay, right? Why does the first retracement happen, Ash? Lots of reasons. Let me give you a couple of really big Forex ones. Okay, so when prices get up in here. Okay, so now let's say you're the Forex broker, okay, and you've got the trade desk here, and you know there's a lot of supply up here. You've got a lot to sell here, okay. Now prices come up here. Have you ever noticed let's say you're watching the news on your platform? You ever notice what happens to the news here? Is the news that they're spitting out positive or negative right here? In other words, are they suggesting you should be buying this market or selling this market? If you ever watch the news, what happens when prices hit a supply level? Do you ever notice? Yeah, it's almost always really good news. They give you lots of reasons why, you know what, you should probably consider buying the market right here. Okay? All right? Now, of course, what's crazy is they're actually your competition. But I'm not even going to go there. But I think you get the point. Okay? So good news is going to happen here. Another reason why prices would come back here, when people see an uptrend in price, with good news, pretty green candles, upsloping indicators and oscillators, what do all the books say? When you have all those things, what should you be doing as a trader? Should you be buying or selling? Right? You should be buying, right? Okay? Exactly. Buy. Right? So that's another reason why people buy. And even if there were no trading books and there was no news, when price is rallying, okay, I've seen this so much on a trading floor, and you see it every day in the markets here. When prices are rallying, that whole bandwagon herd mentality thinking is underway. Look at how people act, and look at people's actions all around the world. You know, people want what everybody else has. They see a bunch of people buying into a market, they want to buy into a market, right? Very few people have the courage to kind of think for themselves and do their own thing, right? It's all this herd mentality. Buying and selling, right? Okay. iPhone 4 comes out. There's people standing out, camping out all night with sleeping bags outside of these stores. Amazing, right? But that's what people do. So take that information and learn how to get paid from that information in the markets. Okay. All right. So we have these 4 items here, and again, the last one that you can add to this is the number of retracements. Remember, the more retracements into an area, the less, the weaker that area is by definition because you're removing some of the supply and demand. So the moral of the story is today, instead of taking the initial breakout, like most people do and like all the books tell you to do, okay, make sure you focus on, consider letting that initial breakout happen because that gives you all the information you need, and then buy or sell on the first retracement back into the origin of that breakout. Okay? Right? Getting out of the trade, Janetta, is you want to be identifying the nearest opposing supply or demand level. Okay? And of course, we want to be trading in the direction of trend. Like I told you, there are more of these things to consider. Some of them I'm sure you can figure out and know. But I wanted to give you some of the important ones here today. And most importantly, I wanted to really hopefully get you thinking, thinking the markets properly because when you think them the right way, it's not that difficult. Doing it is another story, but I think you get the point there. So my message, again, consider ignoring the initial breakout and consider getting in on the first retracement to that breakout. It's a huge filter that will help you if you do it the right way. Let me put my email address in here, okay? And hopefully that was helpful. I know we're kind of out of time here, and I went quick because I knew we started a few minutes late. But there's my email address, Seiden@tradingacademy.com. Really hope that was helpful. And if you have any questions, certainly send me an email. And yes, so we'll follow. I'm in FXStreet twice a month. So our next session. I don't know when the date is. Maybe FXStreet does. But our next session, we won't be looking at any of this stuff. Instead, we'll go to the live charts. We'll look at very short time frames to hopefully find a setup during our session. And we'll also identify opportunities on larger time frames. So our next session will be all in the live market, applying what we learned today. Okay? And if you've sent an email recently, you didn't get a response, apologize for that. Please resend it. I'm pretty caught up on emails. Have a great day, everybody.